All right, the Candle Range Theory Trader back with a video on how the banks trade the currency market exposed. So let's get into it. Now, number one, who are the major players in the Forex market? When you look at the charts, you got to wonder, okay, who's like controlling what we see on the chart? You have central banks like the Fed, Bank of Japan, other large banks, okay, that are tied to nations. You also have commercial banks like JP Morgan and Goldman Sachs. And you also have huge hedge funds and speculators, folks with like billions of dollars that are able they can inject into the market at will. George Soros, those types. So we're going to look at a commercial bank because a commercial bank, what their goal or their role is to provide liquidity for the market. Commercial banks quote buy and sell prices for us clients. Anybody, even by somebody who's looking to take a trip that's not even trying to make money from the Forex market. Let's just say they want to travel from the United States to Japan and they need to exchange their currency. They're going to go to a institution and that institution is going to provide them a quote based on what the bank is saying the currency is worth at that time. Okay. So it's their job as market makers to make sure that people can transact that business. Now, the number one thing I want you to understand in this part of the presentation is this: most of the bank's money comes from the spread on currencies that they quote, which is the difference between the bid and the ask price. I know some people talk about how the market is manipulated and things of that nature, but you have to understand every time a person exchanges currency, though the bid and the ask is relatively small, they are doing billions of transactions. So those pennies and those fractions of pennies, those fraction of a pip, that they add up. So that's where most of the money is coming from when it comes to being a commercial bank and providing liquidity for the market. They're not doing it for free. They're not doing it to be nice. All right. Now, in terms of providing this liquidity to the market, how can we make that make sense to us? Who, we don't own banks. How can we make that make sense to us on the ground level? Think about buying or selling a currency like just buying, say, a bottle of water. All right. Now, at a big supermarket like Costco or Walmart, okay, that has big quantities of these bottles of water, anybody can go in there and buy a bottle of water at any given time. Okay, so that's how the bank operates. They have just not a limited, not an unlimited supply of, let's say, water bottles, but they have enough to accommodate everybody's demand, is what I'm saying. Okay, so when it comes to us going in there and buying, let's say, 500 bottles, let's say we want 1,000 bottles of water, that's not going to move the price, okay, because they have millions and millions and millions of bottles, right? So it's going to take a very big order in order to move the price, is the point of what I'm saying here. But the bank is like that superstore that says, you know what, no matter what you want to buy, we can provide it for you. Let's say, like I said, in this case, bottles of water. We're in business to make sure everybody can buy and sell water as they need to. So there you go, without the price getting too out of control. Now, the number one rule of looking at the market is this: the money is going to flow where it can get the best return for the least amount of risk. And I'm going to show you how it does that in a few seconds here. Now, people often wonder, is the price manipulated by market makers or the banks? Kind of. So here's the deal. Remember our analogy about people buying water bottles. When the market maker gets hit with a huge order, what they need to do is reduce their risk. Okay, so they can shade their quotes, they can lower the bid and ask, they can do all sorts of things to make sure they can accommodate that large order. And at the same time, what they can also do is, because they can see the order flow and clusters of stop losses, limit orders, pending orders, etc., they can tap that price towards that level to make sure that there's enough liquidity in the market so it can keep operating, right? So, and of course, people call that either liquidity hunting, liquidity sweeps, or stop hunting. Okay. And it does happen because the thing is this: if someone has a large demand, there needs to be a supply and able to accommodate it. So what the bank is going to do is to make sure that they can accommodate that large order. Before they do that, let's say, hey, look, we need to get price low enough and create enough of liquidity so that we can, when the buy order comes, we can handle it. But it's better seen than explained. So I'm going to show it to you in just a second. Let's remember as well, too, that banks also trade with their own money on a prop desk, and they can also see incoming client orders before they're even executed. So they already have an unfair advantage. Okay, that's called front running. So we can't compete with the banks. Okay, we can only follow their lead. So here's what a retail trader is going to see when it comes to a regular chart. So I'm going to show you just a brief example of US dollar chart. Okay, so simple chart here on TradingView. Let's focus on this green candle right here. Let's just say you're a retail buyer And you're looking at this candle right here that spiked down. And on the open of this daily candle, you were going to place a buy position, and your stop loss is going to be below this candle's low, right? Okay, so let's just say you got a $1 million position. And if you win, you win $2 million. But if you lose, you're going to lose $750,000. But remember this, I know that it's called stop loss in the trading world on the retail side, but this is really an order. You are buying here, but you are selling here for it all. So this is actually a sell order. This is telling the bank, I will sell my position down here if price goes against me. And you're not the only one who's doing it. Okay, there are tons of institutions and people that are placing stops at similar levels. So what this does is create a ton of orders. Because remember I talked about that buy order, that big buy order? They have to have the liquidity in order to meet it. So if the retail buyer bought USD JPY, let's say 99.96, okay, down here, right? And if they lose, $750,000 if it gets hit, the bank knows that. Okay, there's a big old order down here just waiting to be filled. Okay, because what you're doing is you're telling the bank, hey, I want to sell when price gets down here. That's neither good nor bad, it's just what it is. Now, this is what a market maker sees. Okay. Now, and you see here what happened at the result of this. But there are a ton of sell orders. Let's just say we're 200 million, and that's probably too small of a number. Down here at this level, right here, because a lot of people bought right here. Okay. So, and what they did was when people place their orders down there, it creates a ton of demand. A ton of demand at this price level. Okay. So when the market maker knows that there's a ton of demand down here, all they're going to do is say, okay, well, we got a ton of demand. Let's go down there and meet it. And as well, like I said, maybe there's a big buy order up here, but they're going to have a hard time getting the market up here if they can't first meet this demand right here. So they'll meet it right here, and then the market can just move up very, very nicely. Okay, and they're profiting from the spread all along the way too. Okay, and it makes this big move that much easier. But first, they got to do is meet the demand. That's all they did. Is just meet the demand, right? And if these orders aren't getting filled, the market cannot stay liquid. So if the transaction was face to face, here's how it would look. Trader will tell the banker, I want to buy USD JPY at 99.96. Bank says, okay, we'll sell it to you. What price do you want to sell it at? Or we call that a stop loss, but all the bank is saying, okay, where do you want to sell it? Okay, you're going to buy. Okay, now where do you want to sell? Trader says, okay, if it goes to 95.74, I'll sell. Okay, now, but you're going to sell for a loss. Now the big bank says, okay, so we got your buy order in. And we got your, like I said, stop loss. But of course, it's a pending order because it hasn't been filled yet. But if price reaches 95.74, we're going to meet that order as well because they have to take both sides of the trade. We'll sell it and we'll buy it. We do both because we're the bank. All right. Now, other traders and hedge funds are going to do the exact same thing. We're going to buy at 99.62, but all those stops are around 95.74, 95.82. 97.89. Okay, various stop losses, but I promise all those stop losses are down here in this general range. So you see how price opened and it went all the way down to fill all of this demand, right? Because that's what they said they wanted. And then reverses. That's it. That's all. So as well, the bank prop desk can see, look, we got a ton of sell orders down here at that level I just showed you. And we can load up on a ton of buy orders at that price because we know a ton of people will sell it to us. And with all that money, we can move the market nicely. So what are they going to do? Like I said, they're going to go ahead, just drive the price down, do their business, and then go on about their merry way. La-di-da-di-da, all the way up. That's it. That's it. Okay, so once those orders are filled, that's what's happening behind the scenes. This is an 8-hour chart. Okay, the bank has plenty of inventory to offload because they were buying. People were selling. They were buying. The bank is buying right here. Okay. So think about it. If all the sell orders were absorbed down here, okay, because you bought here and then you sold here, the bank bought here. Why would they keep going down? They don't need to. They met all of this demand. All of this demand has been dried up. So now what? We just drive the price up now. The price is going to just go up because I promise there's going to be more demand up here. That's it. That's all there is to it. So let's take a look at a bigger view now, and let's view this with some understanding. These blue lines are going to note the liquidity sweeps that we see here. So this first candle here, notice how they keep going down, going down, going down, going down. Okay, because I promise at this price level, there was a ton of orders. So in order to meet all that demand, they had to buy it up, buy it up, buy it up, buy it up. And that's what makes this big move possible, right? With little stutter steps along the way, another little small sweep here, a little small sweep here. But once price gets up here, okay, not a lot of people may be willing to sell. Okay. If anything, people are buying up here, right? Because they see, oh man, price has been going up so much, right? So what do a lot of people do? I want to buy now that this has been trending. I'm thinking this trend is going to continue. So it just reverses at this point. At this level, retail traders, folks that don't know any better, and maybe hedge funds that don't have any clue either, okay, they're going to say, okay, we're going to buy at these levels here, but if price goes up, we will sell. So the whole thing just flips. So the bank has a ton of demand up here for sell orders. So if you sell, we'll buy, boom. Price drops. Okay. Retail buys, bank's going to sell it to them. Bank is going to sell, price tanks. Bank is going to sell, price tanks. Bank is going to sell, price tanks, price tanks. Okay. That's just the way the market works. So I'm not trying to say that these guys are evil, even though they do some evil things. I'm not speaking up for the bank. It's just that when you have any market that has a demand for something, they're going to fill the demand. So that's what's going on. That's all that's going on. Now, mostly price simply follows liquidity and orders. That's it. That's all. Day to day, that's where price goes. Where large orders are waiting, okay, some people call that support or resistance, where the stop losses are clustered, or where there's imbalance between buyers and sellers. Okay. That's not necessarily manipulation, it's just how the markets mechanically work. So now that we have all this information in mind, how can we, as regular Joe Smo retro traders trading on our cell phones and laptops, how can we survive? Number one tip, wait for the stop punt or the liquidity sweep. Okay. Wait for that. Then just trade the reversal off of it. That's it. Okay. Well, at least that's the first part. Price is going to spike through a key level, then it reverses. And after that happens, you should be looking to enter. If you miss that part, then just trade with the trend on the higher time frame, whatever you deem that to be. Okay, the big money moves markets on daily and weekly charts. So if you want to monitor those levels, you can definitely do so. But don't trade against what the market is doing. In other words, if you see that they have taken all of this liquidity down here, why are you going short? The market is screaming at you at this point here. We have fulfilled our obligation down here. Now it's time to go the other way. This is not the time to go short. Now, of course, you can catch some little scalps here and there, but generally speaking, this is a pretty healthy long trend. But it started down here. Okay? So focus on risk management. Resist the temptation to risk too much on one trade. Use the higher time frames. Most retail traders lose because they get stop on it. But the winners, they wait for the chaos to be over and then just stay patient. No magic system, no discipline. I'm sorry, just discipline. Sorry. They have to have discipline. But they trade after the banks take what they need. That's the main thing. They wait until all of this is done. They wait until this sweep is done, and then they're buying here. They buy here. They buy here. If they're selling here. Okay, and in this general area, maybe here and also maybe here. But they're playing off of after the bank. They let the bank show their hand and they react. They don't predict. They don't act like they're smarter than the market. They just say, okay, I think the bank probably stopped out a bunch of people here. It's probably time it's going to go the other way. Right? And that's all they do. So, once again, here's another chart. This is a daily. Sweep is done, trade longs. Sweep is done, go short. And here's another sweep, go short. Here's another sweep, possibly go long. Here's another sweep, maybe go short. Here's another sweep, maybe time to go long. Oh, here's another sweep in the same direction. I might need to go long again. Okay, that's it. But they just wait. They just wait. That's all they're doing. So in conclusion, you can't trade like the banks. Okay? You can't. It's not possible. The best hope you have is to ride the wave they help facilitate. So in closing, like an analogy, let's say you have a surfer who's on a surfboard. His or her only job is to get in the water with their surfboard and wait for the ocean to do what it naturally does, generate a huge wave, and all they got to do is just ride it. They don't try to create their own wave. They're not that big. Okay, it will be pointless to try to create your own wave. You're like an ant. Okay, so the ocean is much more bigger and powerful than any of us. These banks have much more money than any of us. So all we do is just wait for the momentum and them to just show their hand, and then we just if you see the wave coming, you can't be scared to hop on board and say, you know what, this is it. You ride it to the shore, and you just do it all over again, right? And not all waves are the same size, but you'll be able to recognize one when one's coming if you've been surfing long enough. Just to draw the analogy, and it's the same thing in trading. You'll know a liquidity sweep or a stop hunt when you see it, and once it's over, then you hop in. So I appreciate your time and attention. Thank you so much for watching, and have a great rest of your day. Take care.